All right. Thank you for joining my LinkedIn Live. Haven't done one in a while. I was kind of waiting to see what was going to happen with the markets and what was happening over the holidays. So I'd been focusing on family time over the holidays, and I had planned to start up, and then everything kind of fell apart. So this is my first LinkedIn Live of 2020. As any of you guys have watched or any of you people out there have watched my LinkedIn Lives, you know I like to talk a lot about the economy, the housing market, what's going on in the single-family rental market. And today I have a great guest, and that guest is Chris Whalen. And Chris Whalen used to formerly be with Kroll Bond Rating, and now he's got his own investment firm. He writes a lot for he has a blog, Institutional Risk Investor. I'll let him talk a lot about that, but Chris is very knowledgeable about what's going on in the capital markets, what's going on in the housing economy, some ideas and thoughts of where he thinks things are going to be going. And so I am going to bring in Chris now. Chris, how's it going?
Another day in paradise, Chris. What can you say?
Absolutely.
Yeah. All right.
So talk to me. Tell me a little bit about your history and how you got to be where you're at.
Noel, I'm an investment banker. Been a member of FINRA for 30 years. Started off on Wall Street at the Federal Reserve Bank of New York. Worked at Bear Stearns, which is where I started to learn about mortgage-backed securities. And then spent a lot of time with my own firm, Institutional Risk Analytics, which was a bank analytics firm, but also did some other very interesting things. Worked on the XBRL project at the SEC, for example, so very data intensive. And then I went back to really focusing on financial institutions. I was involved for a while with Kroll Bond Ratings, a little over 3 years. I helped them build their financials team. Prior to that, I worked for Carrington, a high-touch distress servicer, Ginnie Mae seller servicer, really great firm. And then I decided in March of 17 to go back on my own because I like working on transactions. I wanted a little more freedom to write and comment on the markets. And so today I'm a credit analyst. I worked in the fixed income world. I'm affiliated with Cohen & Company.
All right. Thank you for joining my LinkedIn Live. Haven't done one in a while. I was kind of waiting to see what was going to happen with the markets and what was happening over the holidays. So I'd been focusing on family time over the holidays, and I had planned to start up, and then everything kind of fell apart. So this is my first LinkedIn Live of 2020. As any of you guys have watched or any of you people out there have watched my LinkedIn Lives, you know I like to talk a lot about the economy, the housing market, what's going on in the single-family rental market. And today I have a great guest, and that guest is Chris Whalen. And Chris Whalen used to formerly be with Kroll Bond Rating, and now he's got his own investment firm. He writes a lot for he has a blog, Institutional Risk Investor. I'll let him talk a lot about that, but Chris is very knowledgeable about what's going on in the capital markets, what's going on in the housing economy, some ideas and thoughts of where he thinks things are going to be going. And so I am going to bring in Chris now. Chris, how's it going?
Another day in paradise, Chris. What can you say?
Absolutely.
Yeah. All right.
So talk to me. Tell me a little bit about your history and how you got to be where you're at.
Noel, I'm an investment banker. Been a member of FINRA for 30 years. Started off on Wall Street at the Federal Reserve Bank of New York. Worked at Bear Stearns, which is where I started to learn about mortgage-backed securities. And then spent a lot of time with my own firm, Institutional Risk Analytics, which was a bank analytics firm, but also did some other very interesting things. Worked on the XBRL project at the SEC, for example, so very data intensive. And then I went back to really focusing on financial institutions. I was involved for a while with Kroll Bond Ratings, a little over 3 years. I helped them build their financials team. Prior to that, I worked for Carrington, a high-touch distress servicer, Ginnie Mae seller servicer, really great firm. And then I decided in March of 17 to go back on my own because I like working on transactions. I wanted a little more freedom to write and comment on the markets. And so today I'm a credit analyst. I worked in the fixed income world. I'm affiliated with Cohen & Company in New York, which does a lot of financing for mortgage firms. and trades TBAs and things of that nature. So I'm having a really great time, and I'm hunkered down in New York with my beautiful wife, who's taking good care of me.
Excellent. So give me a little bit more history before that. Where'd you grow up? How'd you get into this business in the first place?
Oh, well, I grew up in Washington, D.C. My father and mother were some of the most interesting Republican operatives of their day. My dad was a speechwriter for Nixon, was the sous chef in the Reagan kitchen cabinet, and was essentially a Republican in what was then a Democratic town, because Washington had been a Democratic town for 50 years after World War II. So I decided I wanted to get out of Washington. I went to work at the Fed of New York, worked for Paul Volcker, worked for Jerry Corrigan, and really learned about financial institutions analysis at that time, the real basics of banking. And I've always been a bank analyst, but I had to, back in the 2000s, start to learn about housing, because that's where all the risk is. A third of all bank balance sheets are one way or another related to housing. And if you follow the commercial credits, they're housing related too. So it's more like half of that 18 trillion in assets has really got housing exposure in it one way or another. So we're finding that out now, by the way. We're in the middle of a big stress test.
Yeah, I agree. And there's so many different opinions out there on what's happening. It's interesting because everyone's got their, I don't know if you've seen much of my videos, but I've seen you speak many times over the years, and I kind of get an idea of where you sit on a lot of things. But, I was one of those people out there that was saying, for the last year that we're not going into a housing crash, or a lot of people are saying we're going into a housing crash, or going into a housing crash. And now all of those people have come back to me and said, I told you so, but it's not fair, because this is not this is not a housing cost crisis that we're in. This is more like a natural disaster.
Yes. And non-banks are not at fault, by the way.
Yeah, non-banks are not at fault, right? And I've got some friends at some pretty big non-banks that are sweating it right now because of the forbearance. And so I want to get into all of these things, and I'll kind of let you lead on where you want to start. But the first question I would like to ask you is, and this is something that I've been reading a little bit, the Fed, right, is really driving a lot of the stimulus and helping the economy, right? So I've read some things where they said if we had just left things alone, the stock market would be down 80%. But how is that relationship between some of the large banks like JP Morgan Chase and things like that? How are they? Isn't there a pretty tight relationship there? And are we nationalizing some of the capital markets right now? And so that's a question that a lot of people have. So I'd really like to talk about that at some point, but let's talk about first just the economy, generally what you're seeing happening and how that is related to the markets, because a lot of people don't understand the liquidity and how that affects things. And I can tell you some anecdotal, stories about the payroll protection program and how that's just a drop in the bucket for a lot of businesses out there who it's not really helping them. And they haven't gotten the money yet, for one, but some of them, especially if you're in the restaurant business, some industries are getting crushed. So I'll let you kind of start where you want to start, and I'll ask some follow-up questions.
Well, I just put out my Q1 bank earnings note, and what I told my clients was that I anticipate that losses rippling through the economy, largely because of the unemployment rate. Unemployment is probably one of the biggest key inputs into any credit model. And so when you see unemployment headed for 20% or higher, what that tells you is that not only are you going to see a lot of individual defaults, but to your point, right, there's a lot of small and mid-sized enterprises out there that have been horribly disrupted, and many of them are going to fail. For example, let's imagine that millions and millions of people seek a payment holiday on their government-insured mortgages, which I think is likely. Mm-hmm. A large number of the people who ask for help are probably going to end up defaulting or needing some kind of loan modification or what have you.
Why do you think that? What's your rationale behind that?
Well, people who have the money to make the payment are going to make the payment. They don't want to complicate their credit profile. Also, if you're astute and you have a lender you can work with, you may want to refi your mortgage in the next 6 to 12 months. So if you have a forbearance on your record, you can't do a refi. Right?
Interesting. Okay.
You're in limbo.
Yeah.
So
Right.
the stronger borrowers are not going to care. The weaker borrowers, people who've been really disrupted, are going to participate. And you hope most of them cure. I mean, that's the hope, right? We're helping them. But ultimately, they have to make up those payments. Whether you're talking to a Ginnie Mae lender or a Fannie Mae Freddie Mac lender, all of them basically have to fix the mortgage at the end of the forbearance.
And is it that some of them say it's a 12-month period you have to pay back that
Well,
amount?
that's
Or
right. That's what some of the lenders are saying. Another option, frankly, would be to modify the mortgage.
right.
But the industry doesn't want to do that because that means they have to buy the mortgage notes, out of the pool.
Oh, interesting. Okay.
And I think that is not really possible right now because of the cost. It's one thing to have to float a couple of months interest in principal, but if you have to go and buy the note out of the pool as a default, which is what happens when a loan goes, more than 90 days delinquent typically, that's expensive. And then, the float of financing those purchases out of mortgage-backed securities is very expensive. So the industry is wisely trying to avoid that with the forbearance. But when these things turn into real defaults, which is what I was writing about in my note, I think they're going to be twice 2008. So for example, banks were up to about 2.5% charge-offs in 2008, 2009. I think it'll be closer to 5. And those bank-owned mortgages are prime. They're the best. So then you look at conventionals, probably looking at 7.5 in that scenario. FHA, well into the teens, mid to high teens, easy. So each one of these markets, the bank portfolio, the conventionals, the government, have different characteristics.
Right.
But I think that if we do see the kind of dislocation of businesses and unemployment that we're talking about now, then yeah, we're going to have a real mess on our hands.
Yeah, and I think what I see is and some of these people are some of my colleagues that I work with are they're under the philosophy or under the thought that or theory that we're going to turn back on the economy, the jobs are all going to come back, and then everything's going to be okay. And I, like I say, anecdotally, even I see a lot of jobs that aren't coming back. A lot of companies that have, even though they're staying okay, they've cut back 30 or 40%, and they're going to stay at that level. So all of that,
that's right.
And so that's what's going to cause a lot of pain too. And I live in a what I call a second home market. So I live in Steamboat Springs, Colorado, and I can tell you right now, and talking to people here, in about 5 months from now, if you want to buy a second home, it's going to be the time to buy a second home if you can do it, because these markets are, everybody's, they're not going to keep their $1 million home, and so it's good for me because we're looking to buy a home here in Steamboat, but it's, and that kind of goes to, is it going to be a V recovery or is it going to be more of a U recovery? And it's not uniform, right? So it's saying that this has hit the whole market. Every single state and city in the whole entire country is affected at once. But they're not all going to go back up at the same pace.
No, and the model is 1930. They're mid-30s, really.
Right.
That was after the crash, after the initial shock and the bank crisis. And people thought things were starting to get better, but then they went down again. And I think to your point about the nature of the recovery, it'll be more like an L. Before the end of last year, 60% of the U.S. economy was services. My guess is that when we reopen and we start to get businesses functioning again, we'll have cut the services sector in half. So it'll be down around a quarter of whatever GDP is at that point. They're talking 30-40% decrease in GDP in the short term, which is consistent with the unemployment numbers. So what I think is that there's going to be an enduring shock. And let's face it, small businesses fail in large numbers every year. They come and they go. It's the most dynamic part of the U.S. economy. But at the same time, when you wipe out a lot of capital, small amounts of capital, but still what enabled people to open a service business like a nail salon or a restaurant or a gas station or whatever, any kind of service business. It's going to take time to rebuild that because people aren't going to have the capital to keep the business open, to finance inventory, to do all the little things you need to do to make a business run. And that to me is the real tragedy here.
Well, yeah. And you see, so I have a family member. My father has a business that rehabs Walmarts. And so they're GC, they're a sub to Walmart's. And so the first thing that happened was everybody stopped paying. Everybody stopped paying their bills. So the GC stopped paying. So now everybody's suing each other to get their money. And then Walmart has a bond, right? So everybody sues that bond or liens the bond. But what's happening is that when you've got let's say it's a $4 million a year business, you have about $1 million tied up in receivables at one time. And those receivables are usually 90 to 160 days to pay out. Right. Well, then everybody stops paying. So now it's a liquidity problem. So the business is there, but people aren't paying. And so the GCs are feeling the pain. Walmart's slow paying everybody. And so that's happening in all kinds of different sectors. And so I've seen some things written saying that, maybe we provide liquidities to some of the larger companies so they can pay their receivables so that it keeps the smaller companies that rely on them in business. And so that's just one aspect, but you talk about the services industry in a market that I live in that is, it's like 70% of the economy is services.
Yeah.
It is, right. It's, people own restaurants, people are thinking they're just cutting it half practically. They're like, I'm closing these two things, I'm keeping this, and they're just keeping what they can. And they're not going to go back. It's going to be a long time before they go reopen or redo something. Right.
Or not. I think a lot of them will actually default. Many of the small businesses will either just close and liquidate, and the proprietor will start a new entity and just start again. A great example I've been using is some of my friends like to go to the Palm. And the Palm filed bankruptcy last week, and they were all so sad. And I said, no, this is called The Beginning. This is like that really bad movie about the mummy, death is only the beginning. So default is only the beginning. And it's a negotiating tactic for a big restaurant chain like the Palm, high end, right? Probably a very good tenant. And they will now go talk to the landlord and say, do you want me to stay in those locations? And the landlord is going to have to come up with a good answer.
Well,
that's what's facing landlords across the board, by the way, in commercial. That's the scenario I just painted for you. That will be repeated over and over again.
And so and that's another thing I have a question for you though, too, because I'm curious about your opinion on this. And this has to do with bailouts, but you're seeing a lot of the commercial, you're seeing even companies who could technically afford to pay and they're just not paying. So what was it? Well, Hobby Lobby's one of them. I can't even remember the name of it. A couple other bigger companies, especially like gyms. They're just saying, we're not paying. And then they're looking into all their locations, and their high value locations are going to continue to pay those leases. And the other ones, they're just stopping paying.
You got it.
And
they'll drop those stores. They'll keep the high value
in a heartbeat. And that goes for retail. And so there could be a 30 to 50% cut, like you say, just in general.
Look, the Fed blew up real estate prices, particularly commercial real estate. The bank regulators were very nervous about this a year ago because loss given default for most of these real estate asset classes was negative. In other words, if you did actually have a default, which was very rare, the bank would sell the property and make money.
Right.
And these are 50 LTV loans typically. So that's how much the real estate values went up. So having done this, now the Fed comes to our rescue, trying to cushion all of this, right? But in the reality is the central banks around the world have been trying to avoid debt deflation for over a decade. And now, because of this Chinese virus, all of a sudden we have this great evacuation all at once. We're flushing everything. And we're getting precisely the kind of debt crisis that the Fed wanted to avoid all along by pumping up the Fed's balance sheet. So it just shows you can't escape the implications of debt at the end of the day.
So I agree with that. And I also think that, when people talk about inflation, consumers don't cause inflation. The markets don't cause inflation, but printing money can cause inflation, right?
Well, yes, and it moves. You know, when I was a young man, we had inflation in the United States, and Paul Volcker had to do his thing and fight it, right? But those were young families that were having babies and buying their first home. So you had consumer price inflation, wage inflation. Now you've got a very different demographic, and the population behaves differently. So where's the inflation? It's in financial assets. Big surprise. It's where the boomers have their money.
Right.
So the bulge has moved through the US economy for 50 years, and the boomers have affected everything. So now the nest egg they thought they had is being attacked. And you will have inflation down the road from the monetary angle, but it was really the price inflation in stocks, particularly bonds, and then commercial and residential real estate.
So let me ask you this. What is your opinion on, and I have opinions on this, and I don't know if I'm misguided, on bailout versus restructuring, bankruptcy?
Mm-hmm.
What's your opinion on the difference? Because there's a lot of people that talk about, well, they've done these leverage buyouts, they've invested all their money into stocks instead of strengthening their balance sheet. Now they're taking a government bailout. Why shouldn't they just go, airlines, for example, why shouldn't they just go through a bankruptcy restructuring? And the people who lose are the bondholders, but you know, the company comes out whole and better in the end, kind of to your point a minute ago.
Yeah.
So what's your opinion on those differences? Because as a layperson, I would say, why create all?
Well, they may do so. They'll do the math and they'll look at, again, bankruptcy as a negotiating tactic, a way to restructure liabilities. The bondholders, the employees will be the ones that end up owning the company.
Right.
The equity holders will be wiped out.
Right.
So, you know, you're right in a sense. So, you know, an airline's a service business with assets that they lease. So all of the planes are secured. You're not going to take the planes away from the leaseholders, right?
Right.
So all that's really left are the gates and the corporation and any other assets that it happens to own. So yeah, you're right. I mean, restructuring that when revenue is going to be half or a third of where it was a year ago, and this will go on for several years, it probably makes sense. Now, the government doesn't want all of this capacity to go away all at once. They want to keep transportation capacity intact.
Right.
So there is a public good argument here. But ultimately, I think most of these things should be restructured because that's the reality. And there are people out there with cash who will benefit, and there are debt holders and equity holders who will pay the price. And it's too bad, but creative destruction is the fastest way to get through this. Now, having said that, on the other hand, you always have to be remembered that the macro bailout, particularly protecting the financial markets, is always better than going the 1930s route. If you have a debt deflation, everyone loses. On the other hand, if you get the financial markets, particularly the equity markets, to stabilize and even stay where they are, at least then you're preserving wealth. But if you go around, you know, to your earlier point, right, and you take stocks down 80%, there isn't much capital left to get the economy going again.
Right.
You know, that's been the story of the U.S. The Fed has targeted interest rates to stoke economic activity, so rates have gone lower and lower and lower, and bondholders have been getting very little, if nothing, in terms of real returns. And all the action has been in either stock or real assets.
Right.
So, welcome to the world, you know.
So yeah, and so those for most people, when they look at the stock market, most people I know look at it and go, it doesn't affect me, but it does.
Oh yes, it does.
So explain that, because that's something that I have a conversation with a lot of people who say, I don't care about the stock market. I care about my business here today, and I care about what's going on with my local business. I don't own stocks. I'm not involved in those companies. It doesn't matter to me. But explain why it does.
Stocks matter because the majority of investors are institutional, pension funds, all sorts of entities which are essentially saving to fund retirement and other needs. A good example of this is the argument about whether banks should suspend their dividends. Well, banks have already suspended share repurchases. Share repurchases were costing the industry over $100 billion last year. So by stopping that, the banking industry is going to retain $110 billion for the largest 20 banks. It'll probably be more like 140 for the whole industry. So that will actually fund the reserve build that we need to put in place to deal with the loan defaults from COVID-19. Banks don't really need to suspend dividends at this point. And the key thing about US banks as opposed to the rest of the world is that our banks are profitable. It doesn't matter how much capital they have. It matters whether or not they have the earnings power to pay off the losses, restructure the loans, and keep on going, right?
Yeah.
I own US Bank. I love US Bank. They didn't need to touch their dividend during the crisis because they kept on going. They were making so much money. Most banks were like that.
Yeah.
And the industry, frankly, cleaned up their own mess, other than Citigroup, which had to be taken over by Treasury. So the way I would say it is that stocks are an important indication of national wealth. There's really two things you watch, the stock market and you watch high yield credit spreads. Right now, high yield debt is around 800 basis points over treasuries, which is bad. You want to have high yield debt trading below 500 over the curve. Otherwise, there's no financing activity for new enterprises. That's where new companies go. They go into the junk bond market.
Yeah.
So, all of these things are important, and people shouldn't be so naive to think that their little Main Street business isn't going to be affected if grandma's pension fund gets wiped out, okay? These things all fit together. And that's why we got to try and catch the whole thing. Many years ago, he was a very smart man. He said, Chris, the task of this generation is to pass the bubble on to the next generation intact, okay? So just think about it that way, Noel.
So look, I want to spend a few more minutes on some of the capital markets and some of the things you're talking about. This is a question that somebody asked me that they wanted me to ask you. And it's how is the fact that the Treasury funding the Fed for special purpose vehicle, is that good or bad?
I think it's necessary. The Treasury has to stand in front. The Fed doesn't take credit risk. So they're willing to provide liquidity to come in and help support some of these markets, AAA CLOs and all this stuff. And there's some argument for this AAA commercial mortgage-backed securities, but not the other tranches. So Treasury puts the cash in the front, they're in the first loss position, and the Fed finances. And the Treasury essentially indemnifies them from loss. Now remember, the Fed and the Treasury are alter egos. Think of the Fed as the opposite of the Treasury. The Treasury is debt. You would, treat it as an asset. So does the Fed. But the Fed is part of the government. The Fed is an expense to the Treasury. So when people really understand how the pipes work, this is why the Fed and the Treasury never do business with one another directly. It would be unseemly, So, it's appropriate for the Fed to provide liquidity because the magnitude of the shock is such that the markets can't do it.
Right. So how is the relationship between the banks and the Fed, being that the banks have an ownership stake in the Fed, but the Fed is a regulator over the banks? How is that a good or a bad thing?
Well, the ownership stake of member banks in the Federal Reserve System is a historical artifact.
Okay.
When they created the Board of Governors in 1929, they really centralized the regional reserve banks and they put Washington in control. So while the Fed banks do in fact own stock, these are nationally chartered corporations, much like Fannie Mae and Freddie Mac, and they have a public policy purpose. So whatever ownership rights the banks have are subordinated to those public policy objectives, in a practical sense.
So this is another question I had, are the capital markets being nationalized?
Yes.
And were they already nationalized?
Yes.
And
look, when the Fed decided to use Fed funds as the target for policy, there's really no choice, because when they set a target for Fed funds and say interest rates should be X, they're essentially pushing the private market out of the way. I mean, my firm trades repo. We finance mortgage securities and whole loans. We can finance an FHA loan once it's endorsed because it's like a T-bill, right? Mm-hmm. So the Fed, by controlling the front end of the market and using it as a policy metric, they have nationalized the money markets very much, and they're in the process of nationalizing everything else. Now, remember, the US has a very active bond market, a private bond market, Most nations don't have this. So the Fed is very reluctant to get too involved with the credit risk in the bond market because they don't know what to do with it. You know, they hired BlackRock to help them with the crisis, great, but they're not in the business of taking credit risk. They're in the business of market risk, and they can deal with that. So,
Interesting.
you know, that's how I think you should think about the Fed. The Fed is there to provide liquidity on good assets. They don't want to be put back into the position they were in 2008, 2009, when they had to take a lot of toxic waste from Bear Stearns in order to convince Jamie Dimon to buy it without a bankruptcy, right? Jamie did
Right.
the country a favor by doing that, and he took a lot of lumps subsequently.
Yeah.
And then Wells Fargo took Wachovia, again, without another bankruptcy.
Yeah.
Very important. So, you know, the Fed facilitated all of these things and ultimately had to, because had they not, we would have had 2 more bankruptcies that year. And it would have been
Big
really,
ones.
really bad.
Yeah. So
benevolence is always best.
So we're
you always get more bang for your buck
right.
by being generous and by being miserable.
So I want to kind of shift towards housing a little bit, but where are we at with, so I work with a lot of builders in the home building space that either build to sell to institutional funds or to sell to homeowners. And, you know, I'm talking about more of the mid to smaller builders. They no longer can get loans to build things that were in place. Some of them continue to get funded because there is a responsibility there by the lender. Let's say it's a Corvest or somebody else, but now right now they're stuck, and there is actually, because of some of the community banks are offering such great financing. So I'm talking 100% loan, 4% with 3 to 6 month non-payment of the loan, or like payment vacation or whatever you want to call it. But now they can't even build the houses to give to them. There are funds who want to buy houses, institutional funds who say, we'll buy these houses because we see, and I'd like to get your opinion on this, we see that a lot of people are going to be stepping down. So they had a $3,000 a month mortgage or rent. Now they're going to go to a $1,500 a month, and they're going to be more responsible. The idea is that these are going to be more responsible renters, because let's say somebody like myself, if I was renting a house and we got into a job problem, I've never not paid my rent ever in my entire life. I would just go figure it out and go to a lesser house. And so there's the thought, and this isn't a thought, this is something I know, the demand for rentals, for affordable rentals, is only going to increase. There's a housing shortage. There's been a housing shortage. But now you've got these builders who would like to build affordable homes. They can't even get the construction loans to do it. They can get the long-term debt if they want it, as far as converting them to rentals, but they can't get the construction loans. So the biggest question everybody has is, when is this market going to unstick? When is there going to be liquidity in the market where people can lend to qualified borrowers to, and another thing I've been hearing too from a lot of these lenders is they've said, okay, look, we don't know when this is going to unstick. They thought 2 weeks ago, they thought it was going to be a week. A week ago, they thought it's going to be 2 weeks. Right now, they don't know. But what they have gone to all their borrowers and said, instead of 10 home builders, we're going to only lend to 2. And you got picked, but we don't know when that's going to start up. So please don't leave us, stick around. So that's created opportunities for other lenders, maybe even unconventional type lenders who would normally not be in this market, who are saying, hey, we need to deploy capital. So an institutional fund that I mentioned earlier, I don't want to mention right now, but that has said to builders, they've said, we'll lend you money at, let's say, a 7%. We get first right of refusal to own these homes if you can turn them into rentals, because we don't know where the market's going to be. So we'll do a cost plus, we'll lend it to you at a certain number. And then as the market changes, if we can rent it at a 6% yield or 7% yield, we'll just keep them on our balance book, whatever, or balance sheet, whatever it is. But when do you think these markets are going to unstick as far as the lending goes?
Not for a while. Think of it this way. The agency market, where I spend most of my time, is really the only liquid market at the moment. The Fed is buying securities selectively in other sectors, but they're not going to stand there and make a market. Right. Back in 2010, 2011, when the market really started to recover and you had people buying distressed homes to turn them into rentals, you had no real secondary market in non-agency loans. the guys at Redwood Trust were just getting going, and they had to go out and sell clients on the idea of buying prime mortgages with high-end customers, good FICOs, good attributes, but with no insurance. They didn't have to pay the 60 basis points to Fannie and Freddie, so the yields were higher. But it took years to get that started. And then later, you started to see short-term construction lending. The construction market had been hurt because banks were forced to reduce the LTVs on construction loans from 70s and 80s down to 50s. So a lot of funds got involved, and they in turn, they have cash equity, right? But they were looking for ways to fund their pipeline to get the equity returns higher, because just doing one house at a time for cash is no fun. You want to be able to take that cash, lever it 10 to 1, and go out and do 5 houses. So,
Exactly.
That was where we were last year. The market was growing. There was greater investor acceptance, but now we've hit the reset button. And we're kind of back to 2012 in a sense, because nobody knows what's going to happen to some of the values. I don't think home prices are going to fall precipitously because, as you said, we have a shortage of assets, right? But at the same time, the willingness of lenders to land on these assets right now is very, very, very curtailed from where it was 6 months ago. So my sense is it's going to take years, just as we're not expecting to see normalized earnings for banks and financials for probably 2 years because of the credit mess we're facing. I would tell you that I don't expect to see these markets come back such that they can get leverage to go along with the equity that these funds certainly have for a couple of years.
Interesting. So do you think there'll be, so is the securitization market of single family rentals, is that totally dried up right now?
At the moment, it is on hold. And look at it this way. Coming in out of March, going into April, the resi community probably had $150 billion worth of stuff in process, in pipelines. Yeah. There was probably another $5 billion worth of private label stuff sloshing around. It wasn't very big private label, but at least it was growing, right? And it was starting to suggest that you could have a larger market that was just investor support. Right. Well, we know how this happens. As soon as the macro environment changes, all of that disappears. So we're seeing a repeat of 2007 through 2009, when people started to get antsy at the end of 6, beginning of 7. You saw New Century fail, and then all of the fringe products that are built on top of the agency market, if you will, just disappeared. They evaporated. And I think that that's kind of where we are now. We're going to start with the Govy and the agency market. I will tell you that the behavior of the FHFA director, Mark Calabria, is undermining the conventional market right now. People are running the Govies because they know what the loss rate is with an FHA mortgage. They know about the expenses for servicing. They don't know what's happening in conventionals right now.
Right.
The FHFA has made noises like Fannie Mae and Freddie Mac are going to back away from their obligation to buy out defaulted loans. If that happens, all bets are off.
So speaking of Freddie and Fannie, so I was at AmeriCatalyst, you were there, and there was I don't know how long it was, an hour presentation about them stepping away from the government. They have all the capitals there to fund them. And I read something, and I don't remember where I read it, where basically the government said, I think that either Freddie or Fannie were still ready to do that. They felt like they could still do that right now. And
they think that now. I mean, Director Calabria apparently still thinks he's going to take them public next year.
So is that just a pipe dream?
I think it's unrealistic in the extreme. If default rates go anywhere close to where I think they're going to go in the next 12 months, the Treasury is going to have to support Fannie Mae and Freddie Mac because of the magnitude of the defaulted mortgages. They're going to have to buy out of pools.
Yeah.
They can't, ultimately the bondholders pay the freight. The servicers are just asset managers. They get reimbursed for everything. So servicing is a no-risk activity. But the bondholders, if we recall what happened last time, right, they bear the cost.
Right.
And that to me is a big concern, because if you destroy the conventional market, if you convince people that they should just do govy loans, which is what's happening right now, then Fannie and Freddie have no value. If you kill their ecosystem, what value do they have? And by the way, no, they were never going to stand on their own. I worked in the ratings world. This is not going to happen. If they don't have a sovereign wrap for the bonds, at least, they can't function. And I have questions as to whether or not the corporate entities can survive on their own. I mean, think about it. If Fannie and Freddie don't have a sovereign guarantee behind them, then they're just Mr. Cooper.
Right.
And there is no way that they can function at the credit spreads that a Mr. Cooper or a Penny Mac or any of these other non-banks have to work with.
So what's going to happen to the non-banks right now?
I think the smaller ones are going to get rolled up. They're going to have funding problems. A lot of little banks, by the way, are in the same boat, along with the credit unions. They all need help. So this is not just a non-bank issue.
Right.
The big guys are fine. In fact, I'll tell you something funny. JP Morgan changed their warehouse criteria last week, and they're essentially backing away from the entire mortgage market. But who is that? Yeah, all the banks have shut down their correspondent channels. They're not buying third party from anybody anymore. But who's out there supporting the correspondent channel this week? It's the top non-banks: Freedom, Mr. Cooper, all the rest of them, Penny Mac, AmeriHome. They're all in there. And that, to me, is a very telling thing. We sit here and bitch and moan about non-banks, but they're the only ones who are supporting the secondary market today. So
and I don't know if you know the answer to this, but I feel like this is going to give opportunity to some, I kind of touched on this a little bit, of some institutional funds that I know that are willing to go out there and fund some builders, because they just need to clip their coupon. And if there's a demand, and then they can back that by owning the homes if they had to, like they're lending, but they're underwriting like they're going to own the house, because they like to own the house, but they can't. They need to own the assets. So I don't know if I'm explaining very well, but where are guys going to go? Where's these small to medium-sized builders who have demand, who have a process, who are in good shape as far as, they know what they're doing, but they can't get lending? Are they just going to have to find these alternative private type funding in order to survive?
No, they're going to go back to where they always went, which is to cash investors in their community.
Right.
The biggest problem facing funds is that they don't know how to get leads. They don't know how to get to know these builders. The guys who do hard money financing for homes and small commercial buildings, the same kind of guys who would come in and buy a tax lien on a house and pay it off. Those are the first places that a builder can go and get, reasonable terms from somebody who's in the market, who actually knows who he is. The funds, they're going to want to get involved, but again, remember, they're looking for very high equity returns. So if they don't have debt to put in alongside the equity, then, they're like a couple of dentists buying rental properties in Des Moines.
They're very limited,
It's very limited. And I think given their risk return parameters and the 20% equity hurdle target they all shoot for, I think until the debt markets come back so that we can enhance those equity returns, it's going to be very hard for these funds to make any headway.
So and right now I'm seeing the discount that they're asking for, because they don't know what the ask is. They don't know what the values are going to go to. We're looking at 25 to 30% discount of what most funds are doing right now. I'm talking about SFR funds, whether they're buying a portfolio, whether they're buying, look, they're more interested in buying an asset with a tenant in it, even if they're not paying, than they are buying a vacant asset right now that they have to then find a tenant, because, but it's really interesting, because we're seeing in our we manage about 22,000 doors. We're at close to 90% collected rent for April. What's going to happen in May? Who knows? But the apartment industry is a whole different spot, because most of the people live there are younger people that are in the service industry. A lot of those people, again, this is anecdotal, and I've read some things, I don't know the data behind it. You're seeing a lot of younger millennials and Generation Z, I guess, or whatever, moving back to the suburbs with their parents. And I think that's going to create different opportunities in the future. A lot of these
Oh,
people aren't
yeah.
going to go back.
Look, New York has been depopulated. Look, I'll tell you
Chicago,
something
same
right now.
thing.
A lot of storefronts, a lot of job opportunities for young people, like you were just saying. They're not going to come back.
Right.
Tourism-related
Oh,
revenue, show business in New York City, okay, Broadway, all of the other activities for tourism. This is Easter. We normally have a deluge in New York City of European, particularly Italian and Latin American families who come here for the holidays. They didn't come this year.
yeah.
And those businesses that normally cater to those people are going to be gone. So I think New York's going to look like the 1980s when I first came here and I was working at the Fed in New York downtown. There's going to be a lot of space in this town. The crowding is going to be alleviated and the parking is going to be really easy.
Yeah, I
Yeah.
spent many years in Chicago, and I've been talking to a lot of people in Chicago about the same thing. And I think, some opportunity that's going to come out of this. And I've been talking about this personally. I wrote an article in Forbes about this, about hipsterbia and these smaller communities that have great live, work, play environment where companies have invested, where they open themselves during the last recession, they opened themselves up for business. They've been thriving. And now a lot of young people that moved out of those areas are moving back because they need to be around family.
Oh, yeah.
And those areas I think are going to thrive in the coming years compared to the more urban areas where you saw, like, what was it? The 90s, you saw a lot of people move to the suburbs. In the 2000s, everybody moved to the city. And now I think now you're going to see everybody kind of moving back to, I don't want to call it suburbs because that kind of, for me, I picture tract housing in the middle of nowhere. I'm talking about these great little communities that have.
Well, they're cheap. You can get a house in Scarsdale for half of what an apartment will cost
Right.
you in New York City.
Exactly.
It reminds me of California in the springtime. California in the spring or Texas in the spring, you have all those beautiful flowers.
Right.
But then the sun comes along and it barbecues all of them, or a fire or whatever, and everything is desolate. So what's going to happen is that we're going to have desolation for a bit, and it's going to look really ugly. And then eventually the economy is going to grow back. But you have just destroyed so much capital, and you've disrupted so many people. And many of those people are going to think long and hard before they take whatever money they got left and try and go back into an expensive, metropolitan area like New York City. Yeah. They're all going to go somewhere else.
Well, I think too with, I've worked remotely for many years, and I've had that privilege of being able to live where I want to live. But I think that the remote working was already becoming more popular and more prevalent. And now companies are realizing, I think we'll see, that they can have a productive workforce that works remotely. And that's going to change things a lot too. I mean, where I live, it's 35% remote workers. I don't know what's going to happen. I mean, in my economy here, the tourism industry has just been decimated. But I think that that's going to enable people to live where they want and where they can afford. And that's going to cause other areas to thrive and other areas not to, that aren't with it. And so I'm trying to think of what the silver lining for any of this is. And,
the silver lining is that people with cash are going to be able to acquire assets cheaply, but they're going to have to be very careful about picking location, because we already had issues in retail. We already had overbuilding in many commercial areas. I mean, high-end residential in New York City is
same as Chicago, Miami, LA, all those areas.
Yeah, the B, C buildings in New York, which people love and they're very comfortable, but the vacancy rates in major cities are actually quite high. And then you have WeWork and all of that. So I think it's going to be a difficult time to really, get things back on track. Anyway, Noel, listen, can we wrap this up?
Yeah, sure. We can wrap it up. I have one question. Do you think this is going to create more of a wealth gap?
Oh, yeah. In the near term, of course it will. It's going to inflame politics. It's going to do a lot of things. It's going to make people, look for help from government and other sources. But I think the government and the Fed have done pretty much all that they can do. And the reality is that coming out of this crisis, I think things are going to change. I think travel is going to be curtailed a great deal. I think that a lot of lifestyle changes are going to have to occur.
Yep.
People are not going to be able to go out as much because there won't be as many restaurants. You know,
Yep.
urban areas like New York or Chicago or Miami, they can regrow service businesses because they have people. But the little services businesses in a second tier city or a suburb that get wiped out, they may not come back.
Yeah. Yeah, I see that. I see that. All right, one last question, and I'll let you go. Where do you see in the next 12 to 18 months? What do you see happening overall in the economy and the housing market, just in general?
GDP is going to take a big hit. It's going to be an L, like I said. We're going to probably lop 20% off of it just because of the disruption of services. And then I think over time it's going to slowly recover. But it's funny. I think people who are too optimistic, who are looking for a sudden rebound, don't understand the consequences of the credit losses that we've seen. That's going to be the toughest part.
Yeah,
and
I agree. I think it's a
little
little bit of denial.
And little stories and sad situations, and it's going to take the banking industry years to work through this.
Interesting.
So, that's what I would tell you. But keep the sunny side up.
Yeah, for sure, for sure. I have some friends who are going to blast me for being negative, but I'm looking at thinking people are realistic, right? Or I think you shouldn't be in denial. I think you should be realistic. Well, I appreciate this. I really appreciate your time. And for everybody watching, I appreciate it. And we'll answer all your questions that you have on LinkedIn Live. And this is we're gonna cut this up in some different snippets of content. We'll get that all to you, Chris. And I really, really, really appreciate you taking your time out to spend with me. And where can people find you? Where do they consume your content? I'll post some links in the comments, but can you just say that real quick?
Oh, sure. Well, I'm on LinkedIn, of course. And my blog is theinstitutionalriskanalyst.com. I am a contributing editor to National Mortgage News. I do a column every other week. And I'm always looking for interesting people to do guest posts on the blog as well. So
okay.
Yeah, I write for American Conservative when I want to cause real trouble.
That's okay.
And there you are. So be well, everyone.
All right. Thanks a lot, Chris. Talk to you later.
Thank you.